May 1st is not a regular date on the calendar this year. For millions of Americans depending on Social Security, this May is where three major system changes collide at once, including a lump sum back pay worth thousands of dollars for some retirees, and a Medicare cost increase that is the steepest we have seen in over a decade. And most people heading into retirement right now have no idea which side of those changes they are actually on. Part of the problem is timing. The rules you use to plan your retirement, the earning limits, the benefit calculations, the Medicare premiums, a lot of those numbers changed in 2026, and the updates did not come with a warning letter in your mailbox. The other part is that the 2.8% KOH law increase you may have heard about tells you almost nothing useful on its own. What it does not tell you is how much of that raise quietly disappears before you ever see it. Through taxes that have not been adjusted in decades, through Medicare surcharges based on income you earned 2 years ago, and through penalties that kick in the moment you cross a threshold most retirees do not even know exists. I have watched people lose money they were fully entitled to simply because they were working off the wrong version of the rules. So if you do not want to open a lighter than expected retirement check next month, grab a piece of paper. There are 4 things you need to verify right now, and we are going through all of them today. Let's start with the number everyone is talking about. The 2.8% KOH increase for 2026. For the average Social Security recipient, that works out to roughly $56 more per month. On paper, that sounds like progress. But here is what that number does not show you. The cost of healthcare in the United States rose faster than general inflation again last year. If you are a retiree spending a significant portion of your fixed income on medications, doctor visits, and insurance premiums, that $56 is not a raise. It is a partial reimbursement for a cost you already absorbed. For many people in this audience, the net gain after Medicare premium increases lands somewhere close to zero. This is what economists call money illusion. The number goes up, so it feels like more. But the purchasing power stays flat or quietly shrinks. That is the honest picture of KOH law in 2026. Now, here is the other side of this month, and this one actually is good news, depending on your situation. The Social Security Fairness Act was signed into law in 2025. It eliminated 2 provisions that had reduced or wiped out Social Security benefits for millions of public sector workers. The windfall elimination provision and the government pension offset, known as WEP and GPO. For 30 years, those 2 rules quietly penalized people who had split their careers between public service jobs and private sector work. Teachers, police officers, firefighters. If you worked in a government job that did not pay into Social Security, WEP could slash your own benefit by hundreds of dollars a month. And if your spouse worked in Social Security covered employment, GPO could eliminate your spousal or survivor benefit almost entirely. The law changed, but the implementation did not happen overnight. SA is working through roughly 3 million affected files manually. That process takes time, which means May of 2026 is when a meaningful number of those affected retirees are finally seeing the corrected payments arrive, including a lump sum back pay check covering the month since the law took effect. I have been close to situations like this for years, and the emotional weight is real. Imagine a woman who spent 30 years as a public school teacher. Her husband spent his career as an engineer, paying into Social Security his entire working life. When he passed away, she expected to receive his survivor benefit. Instead, GPO reduced it to almost nothing because of the pension she had earned through decades of her own work in the classroom. She did not make a financial mistake. She built a career. The law just treated her contribution as a liability. That changes this month for people in her situation. The recalculation is not automatic for everyone. If you were affected by WEP or GPO and you have not yet seen a change in your payment or received any SSA correspondence, it is worth contacting them directly to confirm your file is in the queue. The system is not designed to chase you down. You have to know to ask, and that is the point worth sitting with for a moment. The fact that you did not receive your full benefit was not a reflection of your financial literacy. It was a structural feature of the system, one that held money back until the rules changed or until someone knew how to navigate it. But there is a third way the system is quietly working against you in the very first year of retirement that most people do not see coming. It has nothing to do with WEP or GPO, and it catches people who did everything right. Here is a rule that SSA does not advertise loudly, and it costs people real money every year because of that. If you claim Social Security before your full retirement age, which for most people in this audience lands between 66 and 67, there is an annual earnings limit. In 2026, that number is $24,480. For every $2 you earn above that threshold, SSA withholds $1 of your benefit. Most people hear that number and make a very reasonable calculation. If I am still working and I am going to earn more than $24,480 this year, I should wait to claim. Otherwise, I am just giving money back. That logic sounds right. It is also incomplete. What the SSA website does not make obvious, and what most general financial advice glosses over, is that the annual limit is not the only test that applies. There is a separate rule called the monthly earnings test, and it was specifically designed for people who retire in the middle of a calendar year. Here is how it works. In your first year of retirement, SSA can use a monthly threshold instead of the annual one. In 2026, that monthly limit is $2,040. If you retire in May and you keep your earned income under $2,040 per month for every month after you retire, you can collect your full Social Security benefit for those months, regardless of how much you earned from January through April. Read that again, because this is the part people miss. SSA does not look at your total income for the year. For the months after you officially retire, they look at what you earned in each individual month. Your pre-retirement income does not count against you under the monthly test. Let me make this concrete. Say you are 63. You have been planning to retire at the end of the year, and in February your employer paid out a $40,000 performance bonus. You did the math. $40,000 puts you so far over the $24,480 annual limit that claiming Social Security this year feels impossible. So you keep working, you keep waiting, and you tell yourself you will reassess in January. That is exactly what John did. John is 63. He is in good health, slightly tired of the commute, and has been looking forward to stepping back for 2 years. When the bonus hit in February, he assumed that door had closed for 2026. He did not realize that if he retired in May, SSA would apply the monthly test to his situation. From May onward, he planned to do a little part-time consulting, well under $2,040 a month. Under the monthly rule, he qualifies for his full benefit starting the month he retires. The $40,000 from February is irrelevant to SSA's calculation once the monthly test kicks in. John was leaving months of Social Security income on the table because he was applying the wrong rule to his own situation. I have sat on hold with SSA for 45 minutes, listening to that staticky elevator music they loop on repeat, just to get a representative to confirm this rule in plain language. because it is buried deep enough on their website that most people never find it on their own. That conversation was worth every minute of the wait. The monthly earnings test does not apply forever. It is specific to your first year of retirement, and there are conditions attached. The main one being that you cannot be self-employed and working what SSA considers substantial hours, regardless of what you are paid. If that applies to you, the calculation gets more nuanced, and it is worth a direct conversation with SSA or a benefits-savvy advisor before you make any decisions. But for someone like John, someone with a clean W-2 income history stepping into a low-activity retirement, this rule changes the timeline entirely. It is the difference between retiring in May and retiring in January. Knowing the right rule for your specific situation is not a loophole. It is just knowing how the system actually works. Protecting your benefit from the earnings penalty is one piece of the puzzle. But there is another cost waiting for you that has nothing to do with what you earn after retirement, and it is based on income you earned 2 years ago. Let's talk about the number that showed up quietly in a lot of mailboxes this year. Medicare Part B. The standard premium in 2026 is $206.50 per month. That is up from $185.00 in 2025, an 11.6% increase in a single year. For a married couple where both spouses are on Medicare, that is over $400 a month just for Part B, before you factor in Part D, supplemental coverage, or any out-of-pocket costs. That is the baseline. It gets more expensive from there. If your income was above certain thresholds 2 years ago, meaning your 2024 tax return, you are subject to what SSA calls IRMAA, Income-Related Monthly Adjustment Amount. It is a surcharge layered on top of the standard premium, and it scales up depending on how high your 2024 income was. The detail that catches people off guard is the 2-year lag. SSA is not looking at what you are earning now in retirement. They are looking at your 2024 modified adjusted gross income. If that year was a high income year for any reason, a large Roth conversion, a business sale, or something I will get to in a moment, you are paying the surcharge in 2026, regardless of what your income looks like today. The most common version of this I have seen plays out like this. Someone retires. They decide to downsize, sell the family home, move somewhere smaller, simplify. It is a reasonable, practical decision. The sale closes in 2024, and because they have owned the home for years, the gain is significant. Even after the $500,000 exclusion that married couples get on a primary residence sale, there is taxable gain left over. That gain gets added to their MAJ for 2024. Fast forward to 2026. They open a letter from Medicare. Their Part B premium is not $206.50. It is $295.00 or $394.00 or higher, depending on how far over the IRMAA threshold that 2024 income pushed them. They do what anyone would do. They look for a way to appeal. The form that gets recommended constantly in online retirement forums is the SSA 44. And here is where the advice falls apart. The SSA 44 is a real form. It exists for a real purpose. It allows you to request that SSA use a more recent year's income instead of the standard 2-year-old figure, but only if you qualify based on what SSA defines as a life-changing event. There are 8 qualifying events on that list: marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income-producing property due to disaster or other circumstances beyond your control, loss of pension income, employer settlement payment. Selling your primary residence is not on that list. It does not matter that the sale was driven by a major life transition. It does not matter that your ongoing income in retirement is significantly lower. SSA's system runs on checkboxes, and if your situation does not match one of those 8 boxes exactly, the appeal is denied. I used to assume that if you could simply show SSA that your current income was dramatically lower than your 2024 income, they would use common sense and adjust. That is not how this works. The criteria are fixed, and the home sale scenario fails it clearly. If you are planning to sell your home or do a large Roth conversion or take any action that would meaningfully increase your 2024 or 2025 MAA, it is worth running the IRMAA numbers before you execute, not after. The surcharge brackets are publicly available. A one-time spike in income can follow you into Medicare for 2 full years. And the SSA 44 is unlikely to get you out of it, unless your situation fits one of those 8 categories precisely. The Medicare cost structure is one drain on your retirement income, but there is another one that has been quietly in place since the 1980s, and the 2.8% KOH law you received this year may have just pushed you directly into its path. There is a provision in the Social Security system that has been in place since 1983, and it was originally designed to affect only a small percentage of higher income retirees. Today, it hits millions of ordinary households, and almost nobody talks about it in plain terms. The IRS uses something called provisional income to determine how much of your Social Security benefit is subject to federal income tax. Provisional income is roughly your adjusted gross income plus any tax-exempt interest, plus half of your Social Security benefit. If your provisional income lands between $32,000 and $44,000, and you are married filing jointly, up to 50% of your Social Security benefit can be taxed. If you go above $44,000, up to 85% of your benefit becomes taxable. Those thresholds, $32,000 and $44,000, have not moved since 1984. When those numbers were written into law, they were intended to apply to wealthier retirees. But wages have grown, Social Security benefits have grown through KOH law adjustments every year, and the cost of living has risen significantly over 4 decades. The thresholds did not move with any of it. So what happens in 2026 when SSA adds 2.8% to your monthly benefit? For a meaningful number of retirees who were sitting just under those lines, the KOH law increase is enough to push their provisional income over the threshold. They did not get a raise in any real sense. Their purchasing power stayed flat or declined. But they crossed a line that now makes a larger portion of their benefit taxable. You thought you were getting more. The tax code quietly took a cut of it first. There was no vote to raise taxes on retirees this year. No headline announced it. It happened automatically as a byproduct of a system designed in a different economic era that nobody has updated. To make this concrete, if you are married filing jointly and your combined provisional income sits around $42,000, you may already be in the zone where 50% of your Social Security is taxable. A $56 monthly KOH increase adds $672 to your annual Social Security income. Add half of that to your provisional income calculation, and you may have just crossed into the 85% bracket without doing anything differently than last year. The tax on the additional benefit can exceed the value of the additional benefit itself in certain income ranges. That is the actual math. This is not about people who have significant investment income or large pension payments. Those households likely already knew they were in the taxable range. This is about retirees living on Social Security plus a modest IRA distribution, maybe a small pension. Possibly some part-time income, people who planned carefully and are still getting quietly squeezed by a threshold that was set before most of their grandchildren were born. One more detail worth knowing. The provisional income calculation includes tax-exempt municipal bond interest. You chose a tax-exempt investment specifically to manage your tax exposure in retirement, and SSA still counts it when determining whether your Social Security gets taxed. The exemption applies to the interest itself, not to how SSA treats it in this formula. So here is where your number stands. If you are already over $44,000 as a married couple, 85% of your Social Security is potentially taxable. If you are between $32,000 and $44,000, you are in the 50% zone. And if you are approaching either line, even a modest income change this year, a small Roth conversion, one extra IRA withdrawal, the KOH law itself could shift the math. Knowing where you stand does not change the law, but it does change what decisions you make between now and December 31st, 2026, while there is still time to act. Most people never do that calculation. Not because they are careless, but because nobody told them it mattered. There is a pattern I have watched repeat itself across hundreds of conversations about retirement planning, and it does not have anything to do with intelligence or income level. People who spent 30 or 40 years doing everything right, paying taxes on time, maxing out their 401k when they could, living below their means, often become the least likely to push back when the system shortchanges them in retirement. And there is a reason for that. The generation moving through retirement right now was shaped by a particular set of beliefs about how work and reward are supposed to function. You put in the hours, you follow the rules. The system recognizes your contribution and takes care of you on the other end. That was the implicit contract, and for a long time it felt like a reasonable one. So when someone in that position discovers that Medicare costs $206.50 a month before surcharges, that Social Security can be taxed at 85%, that an earnings limit exists that could have been navigated with a rule they never heard of, the first response is often not anger. It is a kind of quiet resignation. That's just how it works. Everyone deals with it. There's nothing to be done. Psychologists call what is happening underneath that response effort justification. When you have invested decades of hard work into a system, it becomes genuinely uncomfortable to acknowledge that the system has not been optimized in your favor. Accepting the loss feels more manageable than confronting the gap between what you expected and what is actually happening. I understand that response. I have seen it up close enough times to recognize it is not passivity. It is a coping mechanism for a situation that feels too large and too complicated to fight. But here is the shift worth making. Optimizing your retirement income is not the same thing as gaming the system. Using the monthly earnings test is not a loophole. It is a rule SSA wrote specifically for people in that situation. Understanding provisional income thresholds and managing your withdrawals around them is not tax evasion. It is what the tax code was designed to allow. Knowing which life-changing events qualify under SA 44 before you make a major financial move is not cutting corners. It is doing the homework the system expects you to do. The tax code in this country is long and complicated because it was built to serve people who understand it. That includes you. I cannot tell you where healthcare inflation goes from here. I cannot predict what Congress does with those frozen provisional income thresholds, or whether IRMAA brackets get restructured in the next few years. I genuinely do not know. What I do know is how to help you avoid losing money to the system right now, in the rules that exist today. And that part is entirely within reach, if you are willing to look at it differently. The retirees who come out ahead are not the ones with the highest income or the most aggressive investments. They are the ones who stopped assuming the system would automatically reward their decades of good behavior and started treating retirement as something that requires active navigation. That is not cynicism. It is just accuracy. Let's bring this together. 3 things came up in this video that are worth writing down before you close it. First, if you are retiring in the middle of 2026 and you earned significant income earlier in the year, do not let that number scare you away from claiming Social Security now. Ask SSA about the monthly earnings test. What you earned in January through April may be irrelevant to your benefit eligibility starting in May. Get that confirmed for your specific situation before you make any decisions based on the annual limit alone. Second, if you are facing an IRMAA surcharge on your Medicare premium because of a high income year in 2024, understand what the SSA 44 can and cannot do before you spend time on it. Selling your primary residence does not qualify as a life-changing event under SSA's criteria. Know the 8 qualifying events. If your situation does not match, adjust your strategy going forward rather than expecting the appeal to undo a decision that has already been made. Third, run your provisional income number. Add your AGI, your tax-exempt interest, and half your annual Social Security benefit. If that total is approaching $44,000 as a married couple filing jointly, you are close to the threshold where 85% of your benefit becomes federally taxable. There is still time before December 31st, 2026 to make decisions about Roth conversions, about IRA withdrawals, about the timing of other income. That could change where you land. None of this is complicated once you know what to look for. The difficulty has never been the math. It has been knowing which questions to ask. Retirement is not something you step into and hand over to the government to manage. The system has rules that reward people who understand them and quietly penalize people who do not. That is not a conspiracy. It is just how large administrative systems function. They are built for the average case. Your situation is not average. Treat your retirement like a campaign you are running. Not something that happens to you, something you are actively directing. The difference between those 2 postures over a 20 or 30-year retirement is not small. If this kind of analysis is useful to you, the rules behind the rules, the math that does not make the headlines, subscribe to Wes Investor. This is what we do here. See you in the next one.